Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Riiv to receive the top 10 stocks to buy right now. Vehicle charging stocks have been some of the most popular stocks for renewable energy investors over the last 3 years or so. But is this an industry you should be buying into now, or should you be running for the hills? That's the question I'm going to explore today. My name is Travis Hoium. Thank you for watching Riiv Investing. Please subscribe here on YouTube to get all my content and turn on notifications so you can stay on top of everything that I'm doing. There are two companies I want to highlight today that are really leaders in the EV charging space. That is Chargepoint and Blink Charging. If you're not familiar with what these companies do, there's basically two segments of their business. One is making and selling chargers. That's a majority of where they get their revenue, is by simply selling a charger to a business or a homeowner. And then the other part is offering charging as a service. So they may install a charger and then charge 20 or 30 cents per kilowatt hour as somebody charges their vehicle at that charger. It's a pretty simple business model, and it should be relatively profitable because you're making a piece of hardware and you're selling a service. So in theory, this is a pretty straightforward financial business that should be profitable even as it grows. But that's not what we see in this business, so I want to dig into why. Let's start with the numbers. You can see here that Chargepoint and Blink Charging have both grown like crazy over the last few years. That's really hockey stick growth that we would love to see from growth stocks. But if we move over to the net income side of the income statement, the results are really awful. Blink Charging is losing 50% more money than it's generating in revenue. Chargepoint is losing about 75 cents for every dollar that it generates in revenue. And remember, most of this revenue comes from selling hardware. So this should be a pretty profitable business from the start. Free cash flow also doesn't look any better. So it doesn't appear that there's a lot of non-cash charges because free cash flow is very, very negative for both companies as well. That begs the question, why? And this really gets to this charging business model. One of the things that I always think about with electric vehicle charging as a business is what differentiates you from someone else? Or why would you create a really sticky network that I'm going to visit time and time again? And for charging, there's really nothing to it. There's no reason that I'm going to go to one charger over another because the plugs are exactly the same. If I'm charging in public, I'm going to do it at the most convenient station. That may be a Blink charger. It may be a Chargepoint charger. I think one of the really clarifying things for investors should have been when General Motors announced that they were building basically their own charging network of ghost chargers, if you will. And that included Chargepoint and Blink Charging, along with a number of other companies. And the way that their electric vehicle customers would interact with it is they could see where chargers were on a map in an electric vehicle. And then they would pay General Motors, who would then in turn pay that charging company. So the interface was not an interface from Blink Charging or from Chargepoint. They were interacting with a General Motors app, and that was the intermediary that was providing value. Those chargers were just a commodity. And by the way, they're delivering a commodity in electricity. So there's really not a lot of value there. This should not be a high margin business. And we can see that these are companies that continue to lose money year after year despite growing, and that should be extremely concerning for investors. I know that these stocks have gotten a lot of attention, but when you look at the financial statements and you look at strategically where they sit, there's just not a lot of power in this business. There's no real moat. There's no operating leverage, and there's not even cash flow from making electric vehicle chargers, which there should be at the very, very least. These are stocks that I would absolutely not want to have in my portfolio. I don't know if they're going to go up or down based on speculation short term, but long term, this is not a story that ends well for investors. So I would stay away from electric vehicle charging stocks right now. Do you disagree? I'd love to hear your comments in the comments section below. Remember to follow Riiv Investing here on YouTube. Thank you for watching. I'll see you here next time.